Hello, ladies and gents. Hope you're having a wonderful weekend. So today we're gonna examine. Here we have Tom Lee being interviewed on CNBC, and in fact, this is a really wonderful interview. And I want to point out and show you guys how double speak is being done, and how you guys are being convinced and sort of being misled by the overall media. Although in this particular interview, I gotta say the interviewer is really holding Tom Lee's feet to the fire. But notice the double speak, and notice how the interview starts at Tom Lee calling bottom, and then of course it sort of escalates and develops. Also, I would love to hear your opinion on this entire thing. Of course, whether you think the market has hit bottom or are we going to see further lows, inflation, Kevin Warsh, Fed, war, all of the above. I would love to hear your opinions in the comments below. Don't forget to like and subscribe. Now let's get into things right away.
Now let's bring in Fundstrat's head of research, Tom Lee, also a CNBC contributor, and as you see here with us at Post 9. It's good to have you back.
Great to see you.
Now what for these markets?
I think the bottom's in, Scott, because last week was a period where the war was getting worse and oil was going up, but stocks weren't going down, so that's a good precondition. And today now we have the rate of change, that the war is de-escalating. So I think stocks are now in the process to go back to their all-time highs, and I think maybe get to that 7,300 that we're expecting this year.
Wow. So let's just remind and refresh people's memories a bit. You were looking for a strong start to the year, stocks falling into potentially a bear market.
Yeah.
Most of that you pegged to a new Fed chair coming in and some of the issues that might revolve around monetary policy. Couldn't foresee the outbreak of this war and the conflict, et cetera. Does it matter what caused the bear market for how you project your outlook for the year, or are you confident that we had this event, an existential event for the market, it reacted negatively, and now we're going to rebuild our way back?
Yeah, I think things have possibly changed, Scott, because this war pulled forward a lot of repositioning. You know, we know people have gone flat or raised cash, and they were ready to own defensive positioning. And we also had a rolling bear market last year in energy and financials, and this year in Mag 7 and software. So something like 70% of the S&P has already been through a rolling bear market. So I think the possibility is that the summer lull that could happen won't be as deep because we've already fallen 8%.
What's the makeup of the move back towards record highs, like you just said you thought we would do? What does the makeup of the market look like in that scenario?
I think the leadership has been revealed in the last 6 weeks because since the war started, the number one performing asset class has been crypto, Ethereum, and then energy stocks, Mag 7 software, financials. So to me, that's the group that's leading us up. You know, energy went up for obvious reasons.
Sure. Isn't it going to go down now for obvious reasons?
Yes. And then the negative correlation to oil was the highest in almost a decade for the Mag 7, Ethereum, and software. So I think that as oil flattens or cools or the curve flattens, those names are going to get a bid, and they've gotten already cheap. We know the Mag 7 is trading almost at a market multiple.
When you know that we sort of banked on the broadening trade, you know, there was a bent towards value, which it had outperformed growth. Is that mostly over now? Because even with oil elevated, we're still going to ask ourselves questions about a slowdown in the economy, right? Or no? And
there's still a shock rippling through the economy.
Which we maybe haven't felt quite yet?
Correct. Yeah, I think there's an inflation shock still coming. I think that the broadening is taking place. The narrowing is, I think, more investors are going to buy U.S. because the U.S. has proven its resilience in this wartime period. Plus, the U.S. makes more money in a war. But the broadening is that more U.S. stocks rise.
Yeah, but if you're telling me the inflation shock is coming, isn't that going to negatively impact the broadening trade?
Yeah, I think it is out there. We just don't know amplitude because, you know, it's like a wave. Like when it hits shore, is it going to be diminished and are people bracing for it? But there should be some inflation shock coming. It sounds like the Fed is already thinking about, you know, still leaning towards cuts, which is good. We'll get some signal.
Well, right now they feel like they're leaning towards doing nothing for the foreseeable future. And if they believe what you just said and believe, then you must believe that they're going to remain on hold for potentially even longer.
Yeah, and it really depends on if consumers and corporates view this as temporary or a change in inflation. So the surveys will matter a lot, as will the incoming reports. But the Fed fund futures show the market's shifting back towards cuts.
All right, so.
All right, now we're going to do a couple of things here. First of all, let me introduce you to the new layout of the channel. Now we're going to also re-examine on the technical side of things, and we'll discuss a little bit what Tom Lee just said. Right, so here is our new layout. This layout, its intention, as you can see on the left side of things right now, first of all, you can see the Patreon address at the top that will allow you to join the community. We'll discuss that in a little bit. Do not forget to put your comments down below. Give me what you think about all this interview, about where the markets are headed in general before we continue. So the new layout is, as you can see, it basically describes how the stochastic RSI momentum indicator functions, right? Kind of a rudimentary, more or less basic approach to it. Of course, it's a little bit more complex, and there's a little bit more of an idea to cyclicality and various other facets that I'm not gonna describe here. We're gonna try and keep it simple so everyone, including everyone, can understand what's going on. We're gonna sort of do this and keep this technical analysis for dummies. So let's examine what we are seeing versus what Tom Lee just said. Now, I'm not even going to discuss the fact of the matter that the ceasefire has already been broken, and it appears to be that we're headed on the geopolitical scene into very uncertain times and very uncertain oil prices, which are going to affect inflation. And I love how Tom addresses Kevin Warsh. We have no idea what he's going to do. Of course, yes, we do know that Trump is far more leaning towards rate cuts, not rate hikes, but it appears to be that the only thing they can do right now is either wait or rate hikes, in fact, and more so, I wouldn't want to speculate. That's not what I do. My expertise is in technical analysis, and that's how I approach the market, data-driven approach, rather than speculating and saying what I feel like, because we all have our opinions. Opinions are like assholes. If you have one, doesn't mean you have to show yours to everyone else. Now, let's get into the analysis, all right? So let's look at how the price action setup is built up right now. We can go over the smaller time frames, which are insignificant. Those are smaller trends that we'll see sort of come in and flow out. More so, before we continue anywhere, I wouldn't want to highlight this ginormous gap that was generated. Before we continue talking about anything, I want to highlight and say that gaps themselves are a side effect. If you do not understand the reasoning to why gaps occur in the first place, yes, you should rely upon them. As you can see, the price action does tend to respect the levels that are associated with the gap open and close levels. But the method and the system is a little bit more sophisticated. About that, of course, if you want to learn, join my community where I teach and tutor one-on-one people who are interested in learning advanced technical analysis, far more than the rudimentary stuff we're going to cover here. But basically, the idea here is that given the setup and given the circumstances, it is far more likely for the price action to be attracted to fill in that gap. Filling in the gap means we're going to see full price action without any further gaps occurring in the process, moving through the price range that has the gap within it. All right, so now we do have that quite large gap which goes all the way from roughly around 6,755 to what we can call 6,614-ish. That is roughly the range, so about 2%. Also notice how Tom Lee mentioned how the market is already down 8%, but that somehow means bottom in some very weird arbitrary way. I'm not sure how or where, in what book or law or rule did Tom pull this out of, saying that 8% is enough. Now notice again, he called bottom, when we're going to see whether that is what we're seeing on the technical side of things. So again, the 1 minute, 5 minutes are insignificant. In fact, it's far more likely for us to see a little bit more movement within the framework of the range we're moving in right now, which is a very narrow range. Again, insignificant. We are seeing multiple channels starting to occur. For those who do not understand what's going on, why do we have two channels happening simultaneously? The green and the red is our slow channel. The slow channel basically means it is derived from a moving average, from the moving average of the price action itself. And so the slow channel is derived from more points. It considers a longer duration from the event horizon, from the absolute edge of where the price action is right now. It goes longer and considers more data, aggregates more data to generate the current long duration, because slower means longer duration, more reliable for a longer duration. Now, as you can see, for example, the fast channel, which is our blue and red, right? Our fast channel is, in fact, pardon me, not what I wanted. Our fast channel right there, as you can see, is a lot narrower, and it within itself is a channel that's moving through or within the framework of the larger channel. So what we can establish is that the larger channel is far more significant and far more dominant. In fact, if you pay attention to the current channel on the 30 minutes, which is going to be very emblematic through the following time frames, as you're going to see, as you notice on both ends, but Greg, look, we're bullish. We know we broke out of the channel. No, that is insignificant. What is more significant to pay attention is where the momentum is headed. Right now, we can see where objectively, by the way, given now that you guys have a proper layout and a breakdown of how the stochastic RSI works like, as you can see and compare right here on the left side or right above me, you can see our K and our D, or our lines that represent the momentum of the price action right now, are already in oversold territory, which, yes, could represent a change in direction, a reversal of the trend. But if you pay attention real close, the line that is dominant, right, is our D, which is our red line. The red line represents our more longer duration, our slower moving average, and so does end up representing bearish momentum. Really, it is a little bit more complex than that. It is the convergence, the crossover, these junctions that we have between the forces that really represents the change in direction and so on and so on. It is a little bit more sophisticated than what is being presented right here above me, but what you have here is enough of a rudimentary understanding to understand the directionality of the momentum we have right now. So I hope by now you guys understand, give or take, what is going on right here on the chart. So we have the slow, right, the green and red channel, and the fast. Let me bring that in so you guys can see that. And the fast, which is our blue and red channel. So as already said, it's far more likely for us to see the price action to correct simply by the magnetic forces, if you will, and more so, if you can see right here on the 30 minutes, we're already starting to get a setup that does lead us to believe we're going to continue and have a little bit more of a bearish price action. In fact, although we have that hole right there, most of the more sharp-eyed people will notice that this is a form of a head and shoulders that is being built up, and so this is not very unheard of for us to see a little bit of stagnation right here around the levels we're in right now, given the smaller time frames. But then once the momentum overturns, we're going to break back down into the larger channel we see right now. You can follow up, of course, on the price action and see whether I was right or wrong. So our first main checkpoint slash destination, if you want to call it so, will be 6,520-ish. Again, that could mean a little bit lower, 6,500, 6,540-ish, even 50 maybe. That's not completely unheard of within the process of filling in the gap that we have right now and fulfilling the momentum as it's going to play out, because as we can see objectively right now, we are now very bearish and have an inclination to continue moving downwards. But that will remain and be true only if we will see that the larger time frame, the larger data aggregation, the larger moving average, if you will, is in agreement with the smaller time frame. That means if we are seeing disagreement, right, and in fact we are moving upwards, so all we could be seeing right now is a temporary correction downwards within a larger framework of an uptrend. But let's see if that is really the case, or are we really moving downwards? In other words, what we are saying, again, to repeat and to make sure everyone understands, as long as the further larger trend is negative following the smaller time frame, it is far more indicative of a continuation within the direction that we are assessing. If not, if contradictive, that potentially means that we're going to have a whole different change in direction now, and basically we potentially are in a bull trend, right? So let's see, let's go to the 45 minutes, and as we can clearly see, we are still objectively very bearish, right? Let's keep things to the right side here so you guys can see we're objectively are bearish. We are seeing that larger sort of short range trend, but as you can see, 45 minutes, again, we still see that larger duration or longer duration trend, which was already respected and acknowledged multiple times as we've penetrated it. Of course, the median is the main level which we have the price action revolve around. In other words, to kind of keep it simple, like so. All of the revolutions that we're going to have, at least within the framework of this channel, are going to be around that median moving on so downwards. I hope you guys can see that now. I keep forgetting the new framework, so yeah, the new overlay. So yeah, pardon me if I forgot and moved things out of frame for a second. So right there, 1 hour, again, we are still seeing very tremendously, significantly bearish time frame. Momentum, sorry. On that time frame, on the hourly time frame, we're still seeing very significantly, predominantly bearish momentum, although we are seeing that corrective measure that we're having right now in the market, that sideways price action, right? So as we consider and go further on, we realize, wait, we are now, as you can look right above me and understand, so what's going on, the 80 to 100%, yes, the remainder of the momentum staying above the 80 signifies the dragging out of that bullish momentum. As you can see, most of the bullish trend here occurred once we've already penetrated and moved above the 80 range, which signifies overbought territory, or more so continuation of bullish momentum. But as you can see, we're having an overturn of momentum, right? Which, as you can see right above me, says that there's a high risk of reversal when we penetrate these levels, and all that depends on where we are headed on the larger, bigger picture of things, right? As we said, now here it appears to be, well, wait, Greg, here this is the longer duration trend is still going upwards, right? Because we have not yet generated enough data points to highlight or shift over that trend, over the fence, if you will. And so it still appears like it is flattening slowly, given how we haven't had yet enough price action or enough data points to have that larger duration trend that considers more data points or goes further back into the past, more information to aggregate to generate that current channel. So if you understood what I just meant, basically over time, the more we're going to have, the more bearish momentum or more bearish price action we are going to have, that longer duration channel will flip over and overturn. Now let's see what we see on the daily. Very same thing. In fact, on the daily, as highlighted right above me, right, the trend not just crossing above that 80, becoming more bullish, right, but riding high keeps it, as you can see right there in a third marking, right, ride high above 80. So we've been riding high, but now we're seeing a breakdown of the momentum. In fact, right now, what is more dominant, as you can identify right here in the numbers right here on the right side, is 99.80, which signifies our D, or a red sort of bearish correlated moving average, is stronger than our bullish moving average. Okay, so we're starting to see cracks. And what I've been saying all along, those who are in the community and are fully aware, this basically is how the market is starting to form lower highs and lower lows, transitioning into a downwards spiral. And so those who think that the bottom have been already achieved and from here on out we're going down, well, the market tends to signal otherwise. right here, here's the only one problematic time frame that we have, the weekly. But remember, even the weekly itself, as we said, works within a framework of something. So basically, as long, and remember, by the way, this is corrective. Why is that corrective? Because we are bullish below the 50, meaning the same way when we are in corrective territory on above the 50 range, right? But when we are bearish dominant, basically opposite on opposite, right? Now what we are having is this corrective measure. That's why this corrective measure is not as strong as your motive movement. Now, why is that? It's because we are in effect actually are moving over and transitioning into a downtrend. But that will remain to be true only if, now that we switch to the monthly, we identify that we truly are in a downtrend, right? And well, lo and behold, we are in a downtrend. In fact, the transition from bullish to bearish momentum, which, if you want to understand momentum, imagine if that your car, you're going 100 miles an hour forward, right? And then you move your foot from the gas pedal. The car doesn't come to a halt and a stop right away immediately on a dime, right? It starts losing speed gradually over time until, if again, of course, if you do press the brake pedal, you accelerate the deceleration, which is bearish momentum in our case. In other words, what we are seeing here is acceleration in reverse. We're seeing acceleration in bearish directionality. And all we're seeing internally right now, all that bullish momentum is merely a corrective measure. The same way when we go up in an uptrend, in a bullish trend, we have bearish corrective measures to keep the market balanced out. In fact, if you're familiar with my analysis and my expectations, and you know that I'm expecting quite severe lows as we're going to progress through this downwards trend, which, as you can see right now, has become already on the quarterly already objectively bearish, overturning and becoming more bearish. That signifies even a longer duration, and of course expands the channel. Expanding the channel, of course, gives it a new low, as now you guys can see why I'm calling out lows such as 3,300. But for you to understand, even if that is not the case, merely by looking and observing at the price action through the recent years, as you can see, the channel on the monthly chart has been retained very heavily, and so very strongly, if you will, almost like reinforced concrete. So at least as a bare minimum, you should prepare yourself for a deeper correction, given what we're seeing here in the momentum, the directionality of the price action, right? The same way, it is far more likely for us to end up at least at 5,600. Of course, I do advocate for even lower, but for that you need to look into the further larger time frames and realize how the curvature is starting to occur, and we're actually moving into a back end of a larger cycle. But for that you need to, of course, learn and understand technical analysis properly. You need to be able to become your own analyst independent, and I highly recommend doing that. You have the address right there. Join my Discord. My community members are fully aware, and I've been informing them. We've been sort of talking about these things, whether it's oil prices, whether the fact of the matter, this whole situation was a trap and was just misleading, and by Trump and potentially even Bibi. It doesn't matter. They together are now cooperating and working in tandem. So I highly recommend joining my community. My community, by the way, is still on a discount. The discount is about to expire soon. So while you still have the opportunity, definitely come here to patreon.com/Greg_Ori_H, as you can see right there on the top. No, sorry, right there on the top. And you now can join only at $70 a month. Why? Only because that discount is going to expire in about a couple of weeks, and then that $70 tier will become a $100 tier. That is the basic initial tier. You can get introduced to the community, join in, get the information. Of course, you can pay annually, giving you 20% more discount on top of things. And there you'll be able to understand more than that rudimentary understanding of technical analysis that I've presented here. You'll be able to go into the advanced realm of things and become your own independent analyst Of course, being your own independent analyst provides you the ability not to listen to such talking heads like Tom Lee. And as you can see, the technical analysis right now is pointing otherwise than what he is saying. The technical analysis of the market is pointing towards a major correction, and he himself acknowledges that. And although he says on one hand the market is going to correct back up to 7,300, but at the same time he says there are inflation risks. He is saying how Kevin Warsh is going to potentially affect the market negatively. There is a lot of double speak going on. He is covering his ass. And in fact, arguably, I would say that the media oftentimes invites him on purpose to mislead the retail for them to do the wrong thing, because guess what? The very same people who are the majority of stockholders in these various major Mag 7 or just in general major companies are the very same people who are owners of these media companies, or at least their friends. So it's not just a coincidence why the retail is being misled to do the wrong thing always. Exactly, it doesn't make sense. Tom Lee himself is literally contradicting himself within a framework of 5 minutes. Ladies and gentlemen, pay attention. So instead of being uninformed, like the vastness of the average Joes out there, go on, learn technical analysis, join my community, so you'll know actually what is going on, instead of relying on these people now and again when they tell you basically the opposite of what's really coming. And at the end of the day, they are still covering their ass. On one hand, it could be just plain ignorance, which I doubt that is the case. Could be pure evil. You doubt. I mean, you judge, right, which one that is. But it doesn't matter. At the end of the day, you as the retail investor, consumer, trader is being misled very badly. So that's it. That's all I had for you today, boys and girls. Join the community, learn technical analysis. From now on, we're going to have this wonderful layout, and I hope to see you on the next video. Don't forget to like, comment, and ring the bell and the notification bell. Otherwise, you'll not be informed when I go live or make such videos. You'll have a wonderful rest of the weekend. See you on the next one. Bye-bye.